Hi, I'm Chris Heisey, Chief Investment Officer from Merrill and Bank of America Private Bank. As we look across 2026, we're seeing a market and an economy powered by a rare combination: strong business activity, supportive fiscal conditions, rising global earnings, and a capital investment cycle that continues to accelerate, particularly around AI infrastructure and reindustrialization. Recently, we've experienced above average volatility across the markets. This volatility has pressured metal prices and high growth mega cap shares. In the context to all of this, today, we're focusing on the 6 key portfolio considerations we believe matter most this year. These potential adjustments reflect what we're seeing in the market, which is broader participation, improving cyclical trends, and a shift toward areas that may have been overlooked. Joining me is Marcy McGregor, Head of Portfolio Strategy for the Chief Investment Office, to help unpack what we're calling the 6 for 26 and the trends, risks, and implications for diversified portfolios this year. Marcy, thanks for joining me.
Thanks for having me, Chris.
So Marcy, how would you describe the broader economic and market environment at this point?
Taking a big step back and looking at the economy for the balance of 2026, we think this is the year where the U.S. and global economy, frankly, may surprise to the upside. If we look at the U.S., there's a tremendous amount of consumer stimulus right on our doorstep, to the tune of $135 to $140 billion coming direct to American consumers during tax season. In our view, this is likely to continue to fuel consumer spending for the balance of the year. But if you look on the other side of the U.S. economy, we got data recently where the U.S. manufacturing economy returned to expansionary territory in January, a really strong start to the year. So when we think about a market, while it may be choppy, there's a tremendous amount of headline noise out there right now. Taking a step back and focusing on the fundamentals, specifically corporate earnings, which we are forecasting to be growing by double-digit percents in 2026, is really what's going to be the long-term driver of this market.
Okay, Marcy, let's take it just a little step further here. Why are small caps and emerging market exposure important in 2026?
If we look at small cap companies, they have lagged their large cap peers for some time, and now we're seeing some momentum as small caps are really playing catch up here. They've gotten a boost from a Fed that had been cutting interest rates, and that in turn is fueling an earnings story here. Now, if we pivot over to emerging markets and look outside of the US, this is really an area that can benefit from AI adoption. We also have a growing earnings story here as well, and the tailwind of a weaker dollar. So in a really well-diversified portfolio, it's not just about owning the US or owning the biggest tech names in 2026. We think the broadening participation in the bull rally is really important here.
So why should investors stay overweight equities? And are there potential international strong opportunities all around the globe?
We remain overweight equities relative to fixed income in a diversified portfolio because fundamentals remain strong. In the US, this is a story that is all about earnings and CapEx. We're forecasting 14% year-over-year EPS growth for the S&P 500, and we believe we are still in the early innings of a really elongated CapEx cycle driven by tech. Outside of the US, there's an opportunity not only driven by earnings and a weaker dollar, but really an AI adoption story and less expensive valuations. So much has been made of how expensive the Magnificent Seven and the biggest tech names have gotten in the US. But for less expensive valuations, I would look at emerging markets. And in the US, I would think about small cap companies and in the value side of large cap.
That's a really good point, Marcy. In terms of the sectors, which sectors appear poised to lead in 2026? Is there something different that's building right now?
I do think there is something different building here because what we're seeing is the strongest market trends right now are in the cyclical parts of the market. And I think this is an extension of the broadening that we saw in the rally at the end of 2025. And I think that's a story that's likely to continue in 2026. So if I think about within US equities, the sectors that we favor, I would start with financials. Financials have a strong credit backdrop and a consumer base that's been really resilient. I would think about utility companies, consumer discretionary. I mentioned earlier the large amount of stimulus that's coming to American households during tax season. That's going to continue to drive this resilient consumer spending growth that we've seen in our data. And then finally, industrials. Because of the fiscal stimulus legislation that was passed last summer, there's a clause for 100% bonus depreciation. We think this can continue to fuel the CapEx cycle. And frankly, in a world of red hot geopolitics, global defense spending is set to continue to rise.
Okay, we've talked a lot about equities, both in the United States and globally. But let's talk about fixed income now. How do we use fixed income? Is it a stabilizer? Is it a ballast like it has been traditionally?
I like fixed income as a diversifier. I do think of it as a ballast, especially during choppier periods in markets. Now, if I think about fixed income, there's an environment here where we can diversify some of our equity risk and still get stable income. But we have a Fed that's cutting interest rates, so I would say neutral duration. We're not taking a tremendous amount of risk here. We're really using fixed income once again as a diversifier in a multi-asset portfolio.
From a thematic perspective, what structural themes should investors think about considering if they have excess cash they'd like to put to work?
A key driver of this environment that we're in is the innovation that's happening. The investment cycle around artificial intelligence and the infrastructure is likely to continue. We also have a really strong consumer driven by generational spending with baby boomers. We have a renaissance in biotechnology. And then finally, this is not just a US story, but a story of rising global defense spending given the backdrop.
Okay, now let's switch over to alternative investments. In the context of everything we just discussed, how might alternative investments come into play for qualified investors?
Alternative investments are another key part of a well-diversified portfolio for qualified investors. So the innovation that's happening often is happening in the private market side of the portfolio. So when we think about ways to gain access to many of these innovation themes, it can be in venture equity or growth equity in private markets. We've also talked a lot about artificial intelligence, and we're at the stage where the infrastructure is really being laid for this revolutionary innovation. A lot of infrastructure investment also happens on the private market side of the portfolio, where there's longer time horizons for these investments to come to fruition. So alternatives are another way to diversify and potentially gain access to themes and investments that are not happening yet in the public equity space.
Now, we can't leave a portfolio discussion without talking about risks. What risks, uncertainties, or under-the-radar factors to these considerations should investors be mindful of?
Now, markets have come a long way in terms of acclimating to the noise and the policy uncertainty, but risks remain. When we look at the Federal Reserve will be getting new leadership this summer, and that can drive policy uncertainty. It's also a midterm election year. Those tend to be hallmarked by volatility, especially as you approach election day. And then geopolitics are a part of investing that is just a reality of investing, but notoriously difficult to forecast. And then finally, when we think about earnings are so critical to our bull market story here, where the proud bull continues to march forward in 2026. But investors are scrutinizing tech earnings now more than ever. As long as fundamentals remain intact, we view periods of episodic volatility as buying opportunities, opportunities to put cash to work, or opportunities to raise allocations that are below your target in areas like emerging markets or small cap equities. Either way, it's going to be really important for investors to stay really well diversified, to understand that it's time in the market that matters and not trying to time the market, especially around headline risk, and to stay invested through these cycles.
Marcy, thanks for helping break down these 6 portfolio considerations for 2026.
It was great being here.
As we've discussed, this year should present a rare alignment of strong business activity, supportive policy, rising global earnings, and an accelerating AI industrial investment cycle. A recap of the 6 considerations you may want to weigh for your portfolio are: be open to small caps and emerging market exposure. Stay overweight in equities, but diversify globally. Be ready for new sector leadership. Keep fixed income as your stabilizer. Be ready to deploy excess cash, particularly around strong themes and opportunities. And for qualified investors, keep alternatives in mind. As always, if you work with an advisor, talk to them about how these themes might fit your specific portfolio positioning and support your long-term goals. I'm Chris Heisey. Thanks for joining us, and we'll see you next time.